You are listening to ChartingWealth.com for Thursday, the 25th of June, 2015. Today's chart shows us one reason that we do not like the summertime trading zone. The adage, sell in May and go away, rings today. How's that? What we see here is we see green candles going up. For those of you who are listening on audio, I'll explain to you what we are seeing. We have candles on the 19th of June. That's a two-day, we're looking at a two-day chart. And on the 23rd of June, going up substantially, shows where the market bottomed out. This is the total market, starting around the 11th, and then on the 15th, and then on the 17th. Then we look at the candle around the 19th. That's the time period when the Fed came out and said they wouldn't be raising the interest rates this month, and if they do raise them in the future, they're going to be very slight. Well, that kicked the market off on an upspur, and it started to cross over, going up on the 23rd, although it didn't quite make it, nor did the derivative oscillator flip totally over. And then what happened as the markets opened on the 24th? They started going down. In fact, the total market was down 1.18% for the day. What did that do? Well, the little trend line that we had started drawing was violated, and the market switched over on the two-day chart, is now in a down mode. Although the candle for the two-day candle, the most recent one, has not covered going down as much as the previous candle went up, but it's still a down move and a down market as per the MACD on the two-day chart, which is what we go by. That's the moving average, convergence, divergence, and the exponential moving average 8, which is what we use. We use a MACD of 10 and 24. We do have some teachings online that you can learn more about the MACD. Please just look for those on the website, chartingwealth.com, or on Facebook and Twitter, where we publish all these things. Now, what we're looking at then is the IYY, the total market, has moved over, going down. Let's look at what happened on the 4-hour chart, which is, of course, the half-day chart. We talked yesterday about how the market had bumped its head on a ceiling, how back on the 22nd, the morning of, when the market had shot up for the last time, what did it do? Well, it finished off at about, let's see, it looks like it closed at about 107.81, so about $108. The next day, it was, that afternoon rather, $108. The next day, about $108. The next day, about $108. The next day, $108. What did you see going on? Well, you saw the market bumping its head. It opened at about $108 or so on Wednesday, the 24th. And what did it do? It went down from there, and then in the afternoon, it went down even further. It is just about to cross the two-day trend line going down on the 4-hour chart. And in fact, the 4-hour chart has already crossed over going down. What does that mean? Well, you have the two-day chart crossing over, going down. I'm sorry, the 4-hour chart crossing over, going down. And at the same time, you do have the two-day chart crossing over, going down. When you have those concur with each other, that is a nice signal for a down move and for consideration to get into a position once you see how the market shakes out after opening in the morning. We do not give advice on getting into trades. We talk, again, only educationally, but pay attention to that. If you have opened yourself up an account where you can virtually trade, look at opening a position where you don't have any money to lose and see how that works out for you. Now, again, the caveat we run into here is we are in the summertime trading zone, and it is herky-jerky with much lower volume. We've switched over now to SPY. Let's take a look at that. That's the Standard & Poor's 500. This is an ETF, an exchange-traded fund that tracks that. Looks very similar to IYY. We had up movements on the 19th and the 23rd. Then we had a down movement when the candle opened and closed on the 24th. And we actually had a move of 0.74 down for the day. And a crossing of the 2-day trend line going down. So let's look at the 4-hour chart and see what we see. Well, again, the same thing we talked about yesterday. The 4-hour chart itself had been bumping up since the 22nd on around the same figures, and then it started rolling over starting this morning and more this afternoon, and the SPY also crossed over going down on the 4-hour chart. And again, back to the 2-day chart, it has been in a down move the entire time after crossing over going down on the 28th. It never recovered and crossed over going up. So now we have a down move being paralleled in both the 4-hour chart and the 2-day chart. Again, typically the kind of thing that you want to look at as a possible time to find a good entry point in a down move. Now for our last index before we get to gold, let's take a look at the Qs. It was down 0.15%, so 0.5% today. It was in an it has been moving up substantially on the 19th and the 23rd, just like the total market and the SPY. But it's interesting, today it did not move down anywhere near the extent that the other indexes moved down. It is still in a down move on the 2-day chart. It has not, however, crossed the 2-day trend line going down. And if we look at the 4-hour chart, we see that the 4-hour chart has not crossed over going down now. It may do that tomorrow, and when it does, that is a good signal that it is paralleling the down move in the 2-day chart. And if that occurs, again, that can be a signal that it is a good time to get in. Let's sort of explain that a little bit. I think that would help by way of a little teaching moment here. If we go, we'll look at, in particular, let's go back to the SPY. The way that it's nice to see setups occur is when you see any of the indicators on the MACD crossing over going down, and then you see the down movement occur. What you want to try to look for when that happens is the short chart will have forced that down move because it moves, of course, quicker. But it takes more short chart down moves to actually get the big chart to move down, and just the opposite. It takes more short chart up moves to turn the big chart over. Just think about how many little waves it takes to make a big wave. So when that occurs, that's great. However, you have the little wave now, a lot of times will back up. And what we like to see is for that little wave to back up. And when it backs up and rolls over and starts moving back in the same direction as the big wave that it originally turned over, that is a good signal for us to know, as we're starting to see right now, that they're going to move in unison together. That is the nicest way to try to enter any kind of trade or investment, is when the big chart's moved in the same direction as the small chart backs up, that is, moves in the opposite direction of the big wave, the big chart, and then turns and starts to move back in the same direction. When that occurs, that's many times the best time to get in. So now let's go back to our 2-day chart and take a look at gold, which has been a slippery commodity here of late. Look at what gold has done on the 2-day chart. It crossed over going down back between the 26th and the 28th, moved down until somewhere around the 9th, and then started moving back up. Did not cross over going up until the Federal Reserve made its little announcement, and then it popped up substantially enough to drag the 2-day trend line into an up position. But then what happened with gold? It then moved over going down between the 19th and the 23rd. And it crossed back over going down on the MACD. Now, when we look at gold, what do we see on the 2-day chart? Now, we've seen between the 19th and the 23rd, we have seen gold cross back over on the MACD, the 2-day MACD. So if we go back and we take a look at gold between the 19th and the 23rd, we see that it crossed over going down on the 22nd. So that crossover going down has continued to carry on. It occurred about the same time that the MACD crossed over and the derivative oscillator crossed over, and it pushed through the 2-day trend line. When you see all of those things set up and gold starts going in the same direction as the big chart, that's letting you know that you've got a nice down movement. It finished the day, that is the afternoon, with a little bit of an up movement. The total loss for the day for gold was 0.25%. That is 0.25%. So gold overall now is in a down move. Gold is in a down move both on the short chart and the long chart. I hope these explanations have been helpful to you as you get into the markets starting on Thursday the 25th. Start looking at things and trying to figure out how it's all shaking out. We appreciate hearing from you here at chartingwealth.com. We appreciate your involvement. Love to hear from you on Facebook and Twitter. Please make sure to sign up for our newsletter and follow us there at the website. We'd love to email you every day our charts and our review once a day, plus our weekly review and forecast every week. Thanks so much. God bless. Wish you the best in your investing from chartingwealth.com.